What's up, everybody? Michael Silva here. Let's celebrate good times. Come on. The Bulls are back in town. We made a huge aggressive move way to where we were at the beginning of April. Woo! Stuck between the range of 4,100 and 4,200. Let me tell you what, if you are celebrating that price action, ooh, and you want to keep that celebration going, you might not want to watch this video because I'm going to give you some realistic realities, actual data that is taking place in these markets. Because let me tell you something. It's all going to look obvious if something bad were to happen. Now, I'm not planning for something bad to happen or hoping that something bad happens, but here's the reality when something bad happens. Something bad happens, and then all of a sudden people try to figure out what just happened. And then they start looking for the narratives. Well, actually, it was because of this and because of that. I'm giving you the reasons now why you should be worried in these marketplaces. This doesn't mean short the market, right? Because shorting is incredibly difficult. And then you add on a layer of zero-date options and higher volatility, it makes it even more difficult to short the market. But I'm going to give you some actual stuff. We're going to be looking into the distribution of returns of the S&P 500. We're going to be looking at macroeconomic data. I got a host of things to show you today, and hopefully it opens your eyes to the realities of what's going on. So if you are overly bullish, you might need to step back to more of the, the edge of the coin, not be so far on heads. And if you're overly bearish, maybe you should step back a little bit to the edge of the coin and pay attention to both sides as well. That's what we do here on the Stock Market Brief Show. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated, and subscribe to the channel. Now, we're going to start off with the S&P 500 on a weekly chart. Guess what? The Bulls made it back on Friday. They recouped the 5-weekly EMA. So all those algos are going to be happy, right? We always watch this weekly 5 EMA. We watch the daily 5 EMA there too as well, but on the smaller time charts. And you can see they were down on the week right around 40.50, and they pushed themselves right back up. So it does show me that, hey, there's a lot of bulls down here, right? Saving the way for the S&P 500. So if we get a weekly close below this level or below the weekly 5 EMA, maybe that'd be something to be a little bit more cautious on going forward. Now, what's going on with the balance sheet? We talked about the balance sheet being reduced, right? Moves to the downside. And that creates what in the S&P 500? Illiquid markets, right? We see more volatility when liquidity leaves the market. And then all of a sudden out of here, we saw this big move up and the whole world was celebrating the bull market is back. And guess what? The market reacted positively when we saw that big boost. That had to do with the banking crisis. That is still going on. But now what? Well, we're starting to head right back down. The S&P 500, however, is just kind of going sideways. Could be distribution, might not be. We'll talk about more specifically in these charts too, and even compare it to 2000 because somebody told me to. Okay, now take a look here. This is liquidity, right? This is basically just consider this liquidity. The red line is the S&P 500, so liabilities and capital, other factors draining the reserve balances. Sven Henrik pointed this specific chart out and its tight correlation, and I've been tracking it since the day he has because it does. It seems actually very, very reliable of a source. And if there's a big divergence, we might need to be careful. Where has there been a divergence? Well, the S&P 500 was making a nice move here, right? Everything was really bullish out on the Twitter sphere, on FinTwit. But what was the blue line doing, right? Liabilities and capital, other factors draining reserve balances. Well, it was heading down, all right? And then eventually what? The S&P 500 caught up to it. So you have a tight correlation, and then all of a sudden, you start to see a break right here. What are we seeing right here? Well, you're starting to see liquidity out. S&P 500 is up. Is that a warning sign? Or can this potentially turn back up and we get another push higher? It's always a possibility. But I'm just calling out the divergence as it stands currently. Take a look at M2. Well, this is a massive percent change from year over year, something that we haven't seen for, in my lifetime. Ever. Like, this goes back as far as I can pull it, at least. Okay, so a huge decline to a negative year-over-year change in M2, and you might be thinking, okay, well, what does that even mean? Well, just think about it this way. What happened when the Fed turned on the bazookas of M2 during the pandemic, right? We saw the move down here on the S&P 500, the black line, and we saw this bazooka shot. And then what happened with the S&P 500? Kaboom, right? And then what happened? Oh, we started talking about tapering. They're not going to taper. And then they started reducing. Boom. Well, what do we see here in the S&P 500? Well, we saw, obviously, liquidity leaves, volatility up, messy markets. That's what that means. Then take a look at credit growth. When credit growth contracts from a rate of change, we're looking year over year rate of change, there is, well, every recession that we've had, dating back to the 80s that I have on this chart, there was a contraction in year over year credit growth. Okay? That doesn't mean that every time, right? Somebody pointed this out on Twitter, every time that we have a contraction in credit growth means that we have a recession. But every recession had a contraction in credit growth. Why is that important? And by the way, the gray shaded areas is the contraction. Well, what are we doing right now? We're contracting, right? The Fed even talked about this, right? Tightening. Banks tightening. Credit growth tightening. That could potentially lead into a recession. Remember 2011? The debt ceiling crisis, right? We talked about this before too, right? There was a boom, contraction in credit growth. But there's no gray shaded area here saying there's a recession. Well, what else was going on during that time? Credit default swaps were on the rise. Boom, right? Where are we right now? Why is this going past so many people's face? I don't get it. Look at where we are. Look to the left of the screen. We haven't been here since the great financial crisis. This was a monster move. And I had to recheck this just to make sure it was accurate. And sure as heck, it is accurate. Look at 1 week, it was up 9%. 1 month, yeah, there's a bull market in credit default swaps. Congratulations. 6 months, up 114%. 1 year, up 300%. Do you remember what happened in 2011 leading into the debt ceiling? That was the debt ceiling crisis. We had the stock market fall, the S&P 500 fall 20% within 4 months. Well, people, we're here right now. We have a warning sign, a warning sign, a warning sign. We have a warning sign. We have a warning sign. We have a warning sign. We are going now into the debt ceiling stuff, right? Biden said there's an emergency meeting May 9th, and Yellen is talking about we might run out of funds by June 1st or whatever it was. All right, what else is going on? Well, oil. Oil is sniffing something out. Look how hard and fast it fell. Now, mind you, things bounce from oversold territories, right? We talked about that on the last episode. Hey, it looks like the stock market could bounce right here, right? And it did. It bounced high and far. Why? Well, we were looking at energy was one of the main factors of this large bottoming tail, and we saw a big follow through. And energy stocks make up for a pretty decent sized portion in the top 10 of the S&P 500, and we saw a bounce. But not only that, we also saw it in financials. Actually, what was the leading sector the other day? Oh my goodness, it was energy. You know, it doesn't take a rocket scientist to see this stuff. You just need to be aware. Now, why is that important right now, seeing this big fall? Okay, did you know that every large move in oil and a rapid rate of change, recessions has preceded that? You don't believe me? Okay, well, let's take a look at the 1 year rate of change dating back to the 80s. And we'll say, hey, what happens when we get a monster rate of change in the price of oil? Oh, right. The 1987 crash, the 1990 crash, the dot-com bubble, the financial crisis. And what do you think, we're going to walk through this unscathed? Look where the rate of change is now. It's coming off hard and fast. I don't know. I'm just saying there's warning signs, right? This isn't a prediction that anything bad's going to happen, but I want to reiterate this once again. If something bad happens and you're standing on the sidelines later and saying, what happened? What took place? I have no idea that this was going to happen. Things fell apart. Well, don't. There's red flags everywhere. I really do hope that Jerome Powell can make this a soft landing and this all goes away and this time was different and the world just goes on and just ignores all of this stuff and everything is fine. That would be the best case scenario to happen. And I can tell you one thing, like, I don't care if the market goes up or down. I'm going to trade it either direction. That's how I play the market. All I'm trying to do is protect capital and keep people just, survive, right? Because I remember 2008. I remember it greatly. I remember the dot-com bust. And I wasn't even that old then, but I remember the dot-com run-up because my teachers were talking about how good Cisco Systems was doing during that time. And I was in elementary school. In 2008, I remember I was getting so excited to potentially save up more money to get involved in the markets, but everywhere I looked, everyone was buying boats, building their backyards out, doing crazy stuff, and I'm sitting there wondering, how is this T-Mobile employee own 3 homes? It was so obvious that something was wrong. I'm just going on now. You can hear the passion in my voice. Whew. All right. What else is going on? Well, we have the yield curve inverted, which apparently doesn't matter anymore to the Fed. 48 basis points inverted, which is the best predictor of a future recession. The 10-year 3-month, right? Because the 10-year 2-year, he said, oh, that doesn't matter no more. We're going to look at the 10-year 3-month. And then all of a sudden that inverted, and now they don't talk about that. That's 182 basis points inverted. Congratulations, we're back to the 1980s. But Michael, the banking crisis is over. PacWest was up 80%. Yeah, it did. But look at the chart. Wow, it fell and it bounced to right there. Congratulations, everybody. Everything is solved for. Like I said, I hope it is. Now, let me remind you. Big up days are typically around big down days. Vice versa, big down days are typically around big up days. Did I say that right? Big up days are by down days and big down days are by big up days. What do I mean? Take a look here. It's very simple, and I'm going to show you on a distribution of returns. If you don't know what that is, I'll try to explain it, my uneducated brain. S&P 500. If I'm looking at a rate of change, it's a one-day rate of change, which means, hey, one day it was up 10%. One day it was down 10%. You know, that's looking back at 2008. But do you notice something here? Let me show you. In times of bear markets, you see what? You see larger up days are surrounded by larger down days. It's bull markets where you see consistency. It's during turbulent markets you get big up days, big down days, and you get sentiment from the bullish and bearish perspective being thrown all over the place. Look at the rate of change. Boom, it expands. Boom, it expands. Boom, it expands. Boom, it expands. And then where are we right now? We're seeing massive volatility in the markets going back and forth. And look at just the amount of down days are surrounded by just the amount of same up days. Now, if you don't know what a distribution of returns looks like, we're going to talk about the bell curve. Okay, a bell curve looks like this, where basically we're going to talk about the daily returns of the S&P 500. 68% of the time, they'll finish within here, right? And sometimes we go outside, right? Not, to a sigma move. And sometimes outside of that, which is, much more rare, we'll have a 3 sigma move. So what does this look like? What's 68% of the time for the S&P 500? Well, if you look at this, this is a bell curve. And this is information dating back to the 60s of the SPX, okay? Most of the times, between the 60s to now, we're around 0% to 0.5%. Or down 0.5% to 0%. That is the majority of the days in the S&P 500. But you start to get out here, right? What does it say? Well, it could be potentially up 1%, potentially up, down 2%. And it shows the amount of occurrences that happen. Okay? So a lot more occurrences take place between 1% down and 1% positive. So when I look at something like this, and I'm like, holy cow, we're about 2% moves daily or 1.5%. You're seeing monster volatility, and you're like, holy moly, that's actually pretty rare when you look at a bell curve. Pretty darn rare. Which means what? It means don't get tricked by these moves. You got to be careful. Okay, Michael, but what about monthly moves? Same situation. Look at a 1-month rate of change dating back to 2008. You typically see larger down moves, larger up moves. More volatility, larger up moves, larger down moves. More volatility, larger up moves, larger down moves on a month-to-month basis. Where are we now? Well, those are some pretty large moves on a month-to-month basis. What's the distribution of returns looks like? The most occurrences typically happen in a month between 0 to 2%. That's where the most occurrences take place dating back to the 60s for the S&P 500. Okay, well, where are we and where have we been since 2022? We're seeing 7% down moves, 7% up moves on the month. Where does that land? That lands us out here on the distribution curve. You tell me where that is here. We're talking, it's not normal, okay? That's the reality of the situation from a statistical standpoint. Okay. Okay. All right. But how's the stock market look like? Well, the NASDAQ composite, I can't deny, it does look very good, right? Why? Well, why does it look good? From a price action technical perspective. Well, we have price action, right? Bottom here in October. Have a higher low, and price right now is contracting very tightly, and a breakout looks like we can start taking it up higher to this over here. Remember, this was a monster. Everyone said it was over and done with. We're good to go, but then we started falling back down. This right here looks like more of a construction of a base. So if we start breaking out further, we can have a stop, and if it gets, okay, fine, whatever. It took me out, and then maybe if it comes back up, try to re-enter back in to go higher. So from a technical perspective, it looks solid. But somebody reached out to me and was like, hey, this is similar to 2000. Have a look at it. Like I responded, I was like, I have looked at it, but maybe it meant more recently just to see where we are. So I was like, all right, I'll pull it up. So I pulled up the NASDAQ composite, went back to 2000, 2001, 2002. I was like, all right, so where are we technically? Well, we're above the 200-day moving average. So where do we get above that 200-day moving average? We were right over here. I'm like, oh, okay. So let me zoom into that. Let me zoom in. Holy macaronis, there was a 50% rally from the October-ish, September-ish bottom, and we got above the 200-day, and we started basing out and flagging. I'm like, wow, actually, that actually looked pretty positive. Like, hey, we had a 50% move. Everything should be done and over with. Well, what happened? Well, actually, that happened. We fell 50% more. That was after reclaiming the 200-day, pushing a little bit higher, and then all of a sudden, we saw more damage. So, what does that mean? Doesn't mean that that's going to happen here. Okay, that's not what the conclusion that I want to get across. The conclusion is, as it stands right now, we're looking pretty bullish. But in a moment's notice, something bad can happen, and we can look back and we'll be like, oh my gosh, I can't believe it. I can't believe it. It was so obvious in hindsight. All right, let's look at the 15-minute time frame on the SPY. We're above the 5-day. The green line I added in. The green line is the quarter-to-date anchored VWAP above the last week's week-to-date. Now, and the month-to-date anchored VWAPs too. So the start of the month, May 6th right now. Okay, the start of the month, great, right? Technically, we're above some key levels, but we ended down, on the week, 0.8%, so down about 0.5%. So not great. We're just going sideways. But hey, at least from a positive note, we moved up, we flagged, we broke out. So now pullbacks to the lower daily expected move could potentially be bought until it's violated. What would a violation look like? To me, maybe not on the day if it comes down here, but if we start breaking this within the week, which is the Friday's low, okay? If that starts breaking, that opens the door to the lower weekly expected move. Okay, also pay attention to where the lower weekly is. It's where that gap fill takes place right there. All right, we saw the bounce building, right? We said, hey, yeah, you can look at this as a bear flag. But then we looked at oil. We looked at Apple. We looked at other products. We're like, yeah, things look like they could potentially bounce. This was a 2 sigma bounce. We came up to the 2 sigma level on the daily expected move on Friday. I didn't think it was going to go that high, but I was prepared for when it did. Okay, now what? Will you be prepared if you get a pullback to this? But if we start breaking this down, be cautious of over here. If we want to get some continued movement, well, let's see if we can break this high to go up to this daily expected move and potentially even push up to the upper weekly expected move. That's all I got for you, everybody. Hope it helps out. See you later.